Or good afternoon if you're watching this on the replay. Welcome to the live series Straight Off the Bat, a show that covers the need to revive, survive, and adapt to the new normal of COVID-19. Join us on Thursdays as we speak to individuals across the financial industry who will help us, because I've learned so much as well, understand financial literacy and education. Today we are joined by our guest, Philip Williams. He's an assistant vice president of fixed income investments for one of the major investment companies in Trinidad and Tobago. He's also the executive chairman and founder of Fill the Gap, which has been in existence since 2016. Today, we'll be covering how to make sense of your money. I'm your host, Pauline Joseph, and I have so many questions about money. Don't let me hog Philip today because I want to find out if I should buy a new car or not, and I want him to tell me. So, but we do have a Q&A at the last 15 minutes, so stick around. I'm sure you want to get this best price, which is free. We're getting his time for free. But before we start and bring him in, make sure to like the Facebook page or follow. I mean, you may not want to like it, but that's fine. Follow it so you can get a notification when we go live, as well as we just recently joined YouTube. For those who are weirdly not on Facebook, hi, that's okay. We have you covered. Go and subscribe on the YouTube channel and you'll get notified when we go live. So let's bring in Philip and have this conversation about money. Hi, Philip. And I know a lot of folks are joining because they saw your Instagram post. And those people, thanks for joining us live. Make sure to follow us so you can get future notifications. So, Philip, can you give us just a little background on money? Like, what was your personal experience? Was the first personal experience that you had with money?
All right, so before I start, let me just say thank you for that introduction, Pauline, and to let you know that I am really excited, and thank you for having me as a guest. So every time I have the opportunity to speak about money, I'm very excited. So my first experience with money, this will take me straight back to when I was a kid. So I guess at that time, it really wouldn't have been about having the latest shoes or clothes. It really, for me, it was about snacks. This is the truth. It was about knuckle and catch and ping pong, and that's really what it was. So I remember I would go to my grandmother's house every Saturday, and she would give me $5. Now you have to think about this in context. $5 then $10 for a little boy like me, it meant no, I am rolling in it. So I would save my money every Saturday. Now, I'm the youngest of 3 siblings, and so one is 10 years older than me, the other is 4 years. I would have sometimes more money. They would spend their allowance, so sometimes they may borrow money from me. They would pay back, but that was like my first experience with money. Very, very first experience. And it's interesting that you asked that because the things that, the relationship you have with money, how your thoughts are shaped is really from your environment, maybe from your parents. Hopefully you learn some stuff at school. But that was my first experience with money, saving money for snacks, to go to the grocery, to stock up. That was my first experience.
That is insane. For those who may not know, I literally just met Philip, so I didn't know this story was going to come. But we had a session with Tanya 2 weeks ago, and I said the exact same thing. My snacks was different. Mine was Bigfoot. Recently they have spicy, but Bigfoot is lashing. And as soon as I got, $1, $1 back then used to stretch further. The first thing I did was snacks. But you did better than me. You saved to go buy it. I just went, as soon as I got it, bam, it was too hot for my hand. I was like, oh my gosh, I need to spend this.
I have to say, because my parents, they wouldn't buy. It's only so much snacks you would get when they go to the grocery. My snacks would run out. So yeah, that's a real life true story. That's it right there. That was the beginning of money. My journey with money. It started with snacks.
Yeah, the new generation wouldn't understand that struggle, and I want parents out there to let them know, I'm sure they know that, let them know already. Anyways, so, we are in a space where it is difficult for a lot of folks to understand how to go through these challenging times. And it's easy for folks to be able to interchange the word savings and investment, right? Because some of us may not have had that conversation with our parents to say, this is what you need to do with your money. So for those out there, when I say those out there, I mean really me. What is the difference between savings and investment?
So first of all, listen, good question. Let's start with what investing is. And I think let's start with the word investment. And I feel as though the minute people hear the word investment, your mind goes to a particular space where only for the wealthy, it's for the big businessman, it's for the person with the fancy degree. And if anybody has, if you have pen and paper out there's some things that you might want to jot down. I want to let you know that you can invest, right? You just have to believe in yourself. You can invest, and that is the way to grow your wealth. So investing is really taking the money that you work so hard for and getting that money to work for you. So it's putting it into an asset. And I know the question might be, Phil, what kind of asset? And we're going to get to that in this discussion because you hear the words like stocks and bonds and mutual funds. And what does that really mean? We're going to break all of that down. But I want you to know that you can invest, and that is the way to grow your wealth. That is the step you need to take to position yourself for financial success, for financial freedom. Keeping in mind your financial situation is not someone else's financial situation, so you need to focus on you. But so that's what investing is, very simply taking your hard-earned money, putting it in an asset, putting it somewhere for to get it working for you. Very different than saving. So sometimes the word savings and investing are used interchangeably. And the thing is, yes, it's putting money aside for a future date to get a return, but there's a vast difference. And the difference is with investing, you are more looking way down the road. You're looking far down. It's more long-term oriented versus saving, which is near-term, right? So it's never, ever confuse saving and investing. Two very, very important vehicles. Yes, they can be used interchangeably. But if I can very simply, let's say, you might want to write this down. If you have $2,000 and you invested it at 3%, say in a savings account. Savings accounts are not paying that now, but I'm just using a number of 3%. At the end of 20 years, you would end up with roughly $3,600. If you take that, you took that same $2,000 and invested it in a long-term asset, say that was returning 10%, your return will be close to $13,000, anywhere between $13,000 and $14,000. So that's the difference between saving and investing. You're really positioning yourself for long-term growth versus saving, where now you're more near-term. You're possibly saving for something like an emergency. You're saving for something that you know is very specific. So the returns are a lot lower versus investing, where your earning potential is a lot higher.
So if you're just joining us, we're here with Philip to have a discussion around investment from a local perspective, because we get so many bombarded informations from the United States and other parts of the world. Let's have the local conversation. Yes, Desiree, yum, hashtag Bigfoot, you know it is, you understand me. And for those who are not aware of what Bankers Association is, just follow that button and you'll get all the notifications when we go live on these sessions. So, Philip, you had a discussion around long-term versus short-term, and I think that's such an important thing for us to discuss, because we are living longer. We are more connected, so we think that the world is, going to disappear at some point in time. But our connectivity is bringing this level of information that may not necessarily reflect the world, because the world is in a position where we are living much longer than we've ever had in the history of time. So as someone who may be in their 20s, you're thinking, and then when I say in 20s, I'm thinking, I'll live this life, whatever. And you're not necessarily thinking about what 60, 70 looks like. So could you break down the idea of short-term versus long-term with your money?
Yeah, sure. So short-term will be anything really short, less than a year. So let's say 1 to 3 years. That's short. Ultra short is 1 year. Once you start to move beyond that 3 year space and it's money that you are putting aside, then you really have to start thinking about, well, okay, I need to put this money to work in a long-term asset that's going to work for me. So short-term, as I said, 1 to 3 years, medium, 3 to 5, anything past 5 years going towards 10 years now, that will be long-term. And it's I like that you mentioned going out to 60, people living longer. Listen, trust me, I do get it. Because I was once 20, 25, and the things that you could be thinking about then is that, listen, it seems far-fetched. It doesn't seem far-fetched that one day you're not going to be working. It does not seem far-fetched that you need to think about retirement. And that is something which is a long-term goal. And it doesn't even necessarily have to be retirement, because I know millennials or young people don't like to hear that word. So it may mean when you determine that, listen, I want to leave the workforce because I'm becoming a consultant, but at some point when your earning capacity is not where it was before, or you just want to have the luxury to chill out. Some people want to retire earlier. Somebody may want to retire at 40, 50. And that's what you need to start thinking about, positioning yourself, because that is a long-term goal. And it is doable in terms of but it depends on how you position yourself. So a short term, so to be a little bit more specific, something that you're saving for let's say towards the end of the year, money that you know you're going to need in a year, 2 years, 3 years. You don't want to put that money to work with something that is long term, because there's risk there, which we can get into. But that's to give you an idea in terms of short, medium, and long term. 1 to 3, 3 to 5, 5 and beyond.
So what you're telling me is this idea of we're gonna just live forever is just because there's in your 20s, and yes, we young people, I say we young people, millennials, have this thing where you're living life for now, and it's such a balance that I don't think we truly understand how we need to create a specific mindset for that, right? So let's assume that you are taking the father role for a second and sharing with our audience what is the key mindset that a person in their 20s and 30s should take with getting their salary every month. What's the key mindset you would share with them?
This mindset is, well, one, mindset is everything. Once you have the right mindset and you combine that with the knowledge, that's what this discussion is about, but mindset. Because a lot of finance, personal finance, the easy part is what people think is technical. So we started off the conversation talking about investing, and that sounds, the real tricky part is the mindset. It's the behavior, it's the decisions that we make. And trust me, I get it, as I said, totally get it. So I was once 20, 25. The mindset that you need to have when you are 20, 30 is one that, listen, these are my best years. I would like to position myself. I want, yes, the whole phrase of YOLO, you only live once. You don't want to ruin it all. So to me, with that is you have to have some balance in it. And the mindset sometimes within living is finding that place of comfort, your simple pleasure, so that you do the things that you like. You don't feel as though you're living a boring life, but you can't blow it all, or you should not blow it all, which is very easy. It's very easy to do that in your 20s. But I think if every 20 or 30-year-old understood, the sooner that they start preparing for their future, that within those years, you give yourself a huge shot, the best shot at achieving these goals. So the first thing, I'll ask the question, who do you pay first? Who are you really paying first? Are you paying the grocery? Are you paying the telephone company? Are you paying the gym? Are you paying, places I don't want to name drop, but the things that we like to do, or that are you paying those entities first? Or are you paying yourself first? Now, paying yourself first, I just want to just clear this up, because somebody might say, well, that sounds so selfish, but paying yourself is really having a line item allotting a certain amount of money that you know, listen, this is for my future self. I am paying myself so that later down the road, my future self is going to say, thank you so much. Thanks for doing this. And it does not necessarily mean, because I know the idea, you can think, well, when I start earning more money, then I would save. Or when this happens, then this would happen. But I'm telling you, I know it always goes that way because you always keep pushing it further, pushing it out. So I'm going to do this, next year when I get the promotion, I'm going to do this when I get my bonus. And it's the importance of having the discipline when you have little or what you think might be little, which really isn't, because somebody may really want to be in the shoes that you are in. Once you start managing that correctly, then you are positioned for when you start to make more money, because guess what's going to happen when you actually do start to make more money? You are now going to be in a position where you're now learning about developing certain habits. So it's very important to have the right mindset. And it comes with a little bit of sacrifice. And I know sacrifice sounds boring, sounds, but you have to think about it as something that you are doing for yourself, something that you are doing that is really special. So it seems as a sacrifice in the beginning. It's not easy. I know that it's not easy, but if you think about it this way, how do you want to feel 10, 15, 20 years down? How exactly do you think you would feel if you look back and you said, listen, in my 20s, I had about 480 paychecks to put aside money. Then 30, I had 360. Every paycheck or every income opportunity you get is really a position to really position yourself. It's an opportunity, to position yourself. Huh? That's really what it is. So you don't want to look back and say, well, listen, boy, I should have done this and I should have. And sometimes a lot of people, unfortunately, find themselves in that situation. So the mindset when you are very young is really about finding that balance, having fun, living a life simple. You find your sweet spot in terms of the things you like to do, but also maintain the balance in terms of the financial goals, the things that you would like to achieve. First thing is paying yourself. It might even just start with the discipline of, if it's just $100, that's fine. It's just $100. You might think that's it is actually, that's a big deal. And you can actually start investing with as little as $100. You do have access to investment products. I want people to know that. I tell people all the time. So what you think is a small deal eventually adds up and it turns into a big deal. So the mindset is sacrificing a bit, some of that, a little bit of delayed gratification, positioning yourself, paying yourself first. And doing everything in your power to associate yourself, have the conversation, because you may not know, just we having this conversation here, you may not know everything about money, but you may have friends. We are in the information age. Look at how we're having this conversation. There are many avenues that you can pick up knowledge to position yourself to make the right decisions with your money and to have the right mindset.
I like what you said about paying yourself first. It conjures the image of when you're in the airplane and they say put the mask on yourself first before you help anybody else. I think that's definitely something you're going to have to address when we have the Q&A with Melanie. Melanie, I see you. Don't worry. We'll get you covered. That's a very difficult question, and I hope Philip is in a position to answer it. So if you're just joining us, we're here with Philip having a discussion about investment. We're going to go on a short break, and on our return, we're going to have a conversation on basic, simple investment opportunities. So we'll see you on the other side. Welcome back to Straight Off the Bat. We're here with Philip having a conversation about investment opportunities because it can be a bit overwhelming, as Melanie has in the comments, being afraid of equity products. I'm like, girl, I don't even know what equity products mean. So that's why we have Philip here to have that conversation. So let's ask Philip, as someone who's not I hear about things like the Robinhood app and stock markets and all these different things, but don't necessarily understand. And you mentioned earlier about, you could start with as small as $100. If I do have $100 and I want to start investing in something, where do I start? Where does the process begin?
All right. So that was, so to be fair, let's start with, because when you started the conversation, we came back off the break, said, we want to know what is and what is. So let's not race too fast ahead because we're going to get there. Very simple. So I want you to know that there are two ways that a company can raise money. So when you hear equity, interchange equity is stocks, right? So the two ways that a company can raise money is either by saying, listen, you know what, I'm going to give you some ownership in this company. You're going to give me some money. And as a result, now you have some rights to share any profits, right? The other way they can do that is saying, listen, can you give me a loan so that I can expand the business and buy the stuff that I need to buy, and I'll pay you back at a certain time. In the big finance world, the complicated term for that is a bond. A bond is really a contractual agreement to pay back because there's a cost to borrow. So the two traditional types of investment vehicles are stocks and bonds, right? So a stock, as I said, is really ownership in a company. They're raising capital so that they can now go on, do the business and generate profits to pay investors a return. So stocks and bonds. So if that wasn't clear, you could still stop and say, Phil, what exactly does that mean? But when you hear stocks, just think of equity. When you hear bonds, just think of a gigantic loan. And same way that you're going to go to the bank to get a loan, it's the same way corporations and governments have to borrow money to do different things. Governments borrow money to build roads, to pay salaries, for infrastructure. It just depends. Now, taking these two traditional types of investments, the stocks or the equity. So let's just say stocks, right? So if you hear stocks, that means equity. And bonds, these two traditional type of investments. An investment company really will pool these investments together in what is known as a mutual fund. So you asked the question of, well, Phil, what's the best one of the best places to start off for a newbie investor? A newcomer investor, a good place to start off is in a mutual fund. And I can explain why. But just let me explain what a mutual fund is. Think about a basket of investments, a basket of stocks and bonds, or sometimes a basket of just stocks or a basket of just bonds. Pool together, all of us pooling our money together, and someone is managing that on our behalf. We pay them a fee and we get the returns from stocks, the stocks and the bonds. Now, you might say, well, Phil, how does a stock earn money? Or how does a bond generate money? A stock will earn money now because if the company is doing well and the profits are increasing, people are going to want to buy this stock and the company can pay a dividend. So you earn either via a dividend, and once a lot of people want to buy the stock, it pushes the price of the stock up. So that's the two ways that you can earn from stocks. Capital appreciation, that's the price going up. So you bought at $1 and now it's $1.50. The stock price has appreciated. The company decides they're going to pay you some of the profits in a dividend, you get some money there. So you earn that way through stocks. With a bond, how you earn is just straight the contractual agreement to pay that interest because there's a cost to borrow. Stocks and bonds. Now, mutual fund, as I said, is a basket. It's bundled together, all of these assets combined together. And think of it, as I said, so they're big investment companies. Some of the banks have mutual funds. You would know some of the mutual funds. There are different mutual funds in Trinidad and Tobago, but it really is a basket of stocks and bonds, and based on the earnings from the asset in this basket, whether it's capital appreciation, dividends, interest, that is how an investor is going to get paid. So if you entered into, if you bought into a mutual fund, that, as I said, there's some of them on our market that is as little as $100. I'll give you an example, a real life example. A mutual fund, so you can have a mutual fund that is just stocks. You could have one that's just more like fixed income bonds, or you could have a blended, so it's stocks and bonds, a more balanced approach, right? A balanced fund gives you the best of the both worlds. It's more moderate, it's not as aggressive. A straight 100% equity fund that's just stocks is the more aggressive because your earning potential is a lot greater. The more stocks that you have, the greater your potential is to earn versus fixed income or versus a bond because you know the interest is guaranteed. We have an agreement. You're going to pay me this interest. That's what the investor gets. With stocks, you're not guaranteed to get a dividend. You're not guaranteed that a stock price will appreciate. And that's why a mutual fund is great for a new investor because now you have someone managing this for you. And that person is a portfolio manager or an investment manager. So what this person does is they look around the world, they see which countries, they look at the industries and they say, listen, I want to buy stocks from this country, or I want to buy stocks from this industry. I want to buy bonds from this country. I want to buy bonds from this in this industry. And they do all of the heavy lifting to make the investment decisions, pool together the assets and give you a return. So that's what a mutual fund does. Highest earning potential is with the equity, straight 100% equity mutual fund. Lower earning capacity with like a fixed income or the bond type in investment. And if you have a balanced approach, you are more moderate. So I'll just stick a pin right there in case you have any questions, if there are any questions in terms of anything that you were not clear on, or was that, did you understand what I was breaking down there?
I may have to replay it again because I was like researching terms as you were speaking. I was like, what does this all mean? But it's fine. It's okay. We'll have a Q&A because I have some questions from Radhika as well as Melanie. So we'll definitely come back to a few of those things. I just want to echo something that Jamelia said. Sacrifice is important to achieve your happiness, especially when we want to be as happy for as long as possible. So I know you had a discussion around stock, and on your Instagram, I saw something around the stock market, right? So can you elaborate, if I were to go onto the Trinidad Tobago Stock Exchange, what am I looking for? What type of conversation should I start with if I were to hire somebody to brokerage? What conversation should I have?
So now the conversation is shifting. So for someone who says, listen, I'm not, I want to take on some more risk, and I have enough mutual funds, so I don't want to invest in a mutual fund, and I want to invest directly in stocks on the local stock market. Well, I would say the first thing that you need to know is really you need to ask yourself, answer the question honestly. And if you can't, you rely on someone else's advice in terms of, am I really in a position to be investing in stocks? That's the first thing I want you to know. Because I know the anxiety of being anxious to have that earning capacity. But if you are in a position where, let's say you have very high or very expensive credit card debt, then it will be in your best interest to pay down that credit card debt first before you start investing in stocks. If you don't have an emergency fund, as in you can't withstand, like if something happens, you don't have cash put aside in a savings type of account that's secure, that you have access to, then you need to you probably just want to hold strain a little bit before you actually do decide to go and invest in the stock market. Because what can happen, I spoke a lot about, capital gains and dividends. Capital gains is just the price of a stock appreciating. Dividends is a share in the profits. Because stocks fluctuate for different reasons, a stock price goes up, stock price goes down. That is the risk in it. You can put $1 in, and next week it is 95 cents. But then next month or next 6 months, it's $1.50. Because there's volatility, you have to be prepared to take that risk. That's the first thing. But to be more specific and answering your question, once you recognize, okay, listen, hey, you know what? I have sufficient emergency funds. I don't have expensive credit card debts. I'm not very, highly indebted to anyone or any entity, and I want to move it, and I have sufficient insurance, then, and I want to invest in stocks. The first thing what you would need to do is open a brokerage account. And when you go on so if you go to the stock exchange website, there's a list of the 6 brokers there. So the commercial banks do offer this service. It's a separate service. So it's the commercial banks that we know about, they offer brokerage services as well as their independent brokers. A broker is going to, one, that's like the middleman. That's a major chess piece in your investment journey, because that's, if you don't have that, you won't be able to access stocks on the stock market. So opening a brokerage account is really like opening a bank account. It's similar. It's the same know your customer stuff. So they're going to ask you for 2 forms of ID. They're going to ask where you work, or if you're self-employed, they're going to ask you for some information that you need. I actually did a post on Fill the Gap on where to go to, where you can find this information. All of the stuff that you need, it's actually on the Fill the Gap Instagram page. So it's a very good question. Once you identify, okay, listen, I'm going to go with this broker now. So you want to assess, and going with a broker depends. Some brokers have high amounts to invest, the minimum fee. Some are very, very low. So you have to go with a broker that is suitable to you. Some brokers provide investment advice, and this is what is important. You might be anxious to start to go on to the stock market. What you need to do now, it's always good, because we are in the information age. Things are very different now. It's easy to get information on a company, but it's easy to get access to someone, relatively easy, that could give you a good read on a company. Because remember, you are going to put your money now in a stock. Let's say you go to stock market. You're putting your money and getting your money to work for you. So before you employ anybody, just as you have to vet it, you have to do the analysis and say, well, okay, is this a good investment or is it a bad investment? And this information is available all online. Companies put out, because they have to publish their financial information. Financial information and financial statements can seem very daunting, but that's why it's important, when you're starting off, you rely on someone who is an expert, who can give you solid investment advice, and you say, listen, this is the amount of money that I have to invest. I've checked out this broker, I've opened the brokerage account. And really, when you open a brokerage account and you put cash in the account, you really just give your broker instructions. It could be via email, it could be via telephone call, it just depends on what the arrangement is. And you say, hey, I would like you to buy X shares on the stock market for me, please, thank you. That's what it is. It's opening a brokerage account, funding it, so that you have access to shares. But it's very important to just check, because different brokerage funds have different fees, they have different minimum balances, so it's really what is convenient to you. And there are brokers, I would say, the spectrum, if you look at it, it is accessible. It's not all just high net worth and thousands of dollars. There are brokerage firms that will open a brokerage account for you with a minimal fee and provide you access to stocks on the local stock market. For the person who, if you are not that aggressive, a mutual fund, a balanced mutual fund, will give you access to international stocks, and US stock markets and global stock markets. It will give you access to local stocks. It will give you access to local bonds and international bonds. So they have like a balanced fund, will give you a blend of different kinds of assets where you diversified versus taking direct position. So you just have to understand the risk. There's more risk in going directly into stocks on the stock market versus in a balanced type of arrangement where you have more assets. That's called diversification. So you probably would have heard the old saying, don't put all your eggs into one basket. That's what a mutual fund does. It spreads out your risk. It gives you access, because all of the investors are pooled together. It gives you access to investments that you otherwise wouldn't have access to. And it gives you access to portfolio management, solid advice. So either or, this is not to deter. This is where, you have to do a risk tolerance, or just kind of assess where you are at. And there are questionnaires for that. That will determine what your relationship is with your money, how you feel about putting your money onto the stock market. Am I going to get really upset or jumpy if I put in $1 and tomorrow it's 99 cents? Or do I have the level of comfort to know, well, listen, 6 months down the road or a couple of months down the road or next year, this dollar is not going to turn into, it might be volatile, but it's going to turn in or translate into a gain for me down the road. So I'll pause there, because I know you're asking local stocks and what is the first thing you need to think about? The first thing, just to recap, first thing you think about is now the time for me to invest. Do I need to really brush up or tighten up certain things and make investing in the stock market a goal, like say a goal for the end of the year? Because now I'm just positioning myself. So am I ready to invest? Yes, I'm ready to invest. Okay, I need to look for an appropriate broker. The broker has to be suitable for me, from a minimum balance standpoint, the fees that are paid and the advice that is given. Once you identify the broker, you say, listen, okay, so I have this check, it's $1,000, $2,000, $5,000. You fund the account. Once the account is funded, then you now give the broker instructions. This is the part, as I said, where you want to rely on someone who can give you solid investment advice, hold your hand in the beginning, coach you through that whole investment process and in terms of what assets or what stocks you should buy on the local stock market.
We have a lot of questions coming in. I really like the question that Melanie brought up around international versus local shares. And we want to touch on all of those questions because it seems like our Q&A is going to get a lot longer than anticipated. So we want to answer some of those questions. So join us. We'll be right back. Hi guys, if you are just joining us, this is the Straight Off the Bat show, a show that covers the need to revive and survive to whatever normal this is with COVID-19. And if you have missed the first 20 minutes of this session, please go back on the replay. It has been invaluable information that I've learned from Philip, who is an assistant vice president of a fixed income investment company for one of the local companies in Trinidad Tobago, and his wealth of knowledge, pun intended, is something that we all need to figure out how to manage our money, right? Because it's not something that unfortunately we were taught when we were in school. So let's look at Melanie's question around investing local versus international, because from a brand perspective, you hear more about the international companies than you do locally. Like, I know about Apple's new announcements with different, they just announced this new facility for ads, which means that their prices of stock may go up. So a lot of the times the media gives us a really good insight into what's happening externally, but then you don't necessarily know what's happening locally. So to expand on Melanie's question, the question really is, how do we decide?
Okay, very good question, Melanie. And the answer to that question is really, what do you have access to? So some people have access to a whole lot of US dollars, and some people have access to only TT dollars. If you only have access to US, so let's start there, because sometimes that maybe don't think. You might say, well, listen, I want to invest on the international market. It's so difficult to get US. What do I do? Right now, I'm just going to go with straight what the facts are, what the data that is out there in terms of performance. So international stock markets, or let's say the S&P, which is an index, or let's say a basket of or group of investments that tracks 500 largest or very large companies in the United States. If you look at the returns there and you see what's happening with where the economy is going, because the Biden administration, they're pumping a lot of money into the system, and that has been boosting stock prices. So the US stock markets in particular have been on a high early this year, and even during COVID has been on a high. Locally, our situation, one, is not that different. So it's two different markets, because here our market is thin. It's anywhere close to around 30 plus securities, say stocks. So it's not as vast. Our stock market is not as sophisticated. So how stock prices react to information is not how stock prices and how volatile, how things are in the international market. But if you have access to US dollars, then it would make sense definitely to invest in US stocks or international stocks, definitely, if you do have access to US dollars. There's opportunity on the local end. So I don't want to say it's bad to invest in Trinidad and put all your money in the United States, because that is not the case. Because you may very well end up with a situation where you have TT dollars that you now have to put to work for you. And what you have to think about is inflation. Over time, prices rise. I mean, inflation is pretty low right now, but over time, prices rise, and that is going to eat away at your purchasing, the power of your dollar, basically. And investing in stocks on the local stock market protects your dollars from inflation eating away at it. So if you have TT dollars to put that you can put to work, it's a great opportunity because of where our stock market is right now. So it was in negative territory, closed the year in negative territory at the end of 2020, but as of a couple of weeks ago, coming into 2021, it still was negative, but as of right now, our local stock market is positive. And that's a good sign. I'll tell you why it's a good sign. Because stock markets generally tend to be a leading indicator of what is going to happen. Generally, it doesn't always pan out that way, but generally, because it says, okay, if investors have a favorable view of Trinidad and the local stock market is heading into positive territory. It suggests that investors are looking forward to what is coming. So they are positioning themselves. So it's an opportunity now because some of the prices of some stocks on the local stock market have been battered. They have been discounted because of COVID and because of all the restrictions. But it is, obviously everything, is hinged on the vaccination and businesses, the economies around the world reopening. So it's not just Trinidad and Tobago. Everybody is feeling the pinch. I think the only place that's really coming out all right out of this is China. So everywhere, most economies are under strain. And that's a great time to invest because one, you may have something, an asset today that feels the brunt, or if you want to say is punished because of where the economy is at, or it's punished because some part of the economic cycle is not in favor of that particular company. But it doesn't change the fact that the company is a solid company. It doesn't change the fact that management has been managing the company for decades and they've been doing well. It doesn't change the fact that they've been able to pay stable dividends and pay out profits. So that's what you have to look at. And that's the kind of asset or that's the kind of stock you want to be choosing. A stock that is undervalued. So really just using as an example, buying $1 for 50 cents. There are opportunities on the local stock market where prices of very good companies have been discounted and you can get them at a bargain. So it's not as straight as saying, as I said, if you only have US dollars, then by all means, certainly you want to invest in the US, you want to invest in international markets so that you get the best for your US dollars. Certainly if you have TT dollars, you want, and you're seeking growth, if you don't go to a equity mutual fund or balanced mutual fund and you want to go to the stock market, there is opportunity for you to position yourself on the local stock market.
Okay. So we have quite a few questions to get to, so we're going to try and spitfire this because time does fly, especially when you're trying to learn about money. Because we're in the same realm as stocks and conversation, I want to ask Casey's question around local brokers versus online brokerage, because I feel like that's such an interesting perspective, because you mentioned earlier, which I wasn't aware of as well, that you open up that account similar to a bank account. So if that's the case from a local perspective, what's the difference with the online and which should you choose?
Very good question. So online brokerage, so international, when you're investing on the international market, online, all of it is online. It's really on this device that we're using right now. You buy and sell stocks on your phone. Download an app and you open the account the same way. It's just a lot more digital. So think about going to the bank, going to a financial institution and opening an account that you don't have to go to the bank and you don't have to present your passport and you can scan all of this stuff and they verify and they know who you are. Everything is done online. So that's the difference. So online it's actually a whole lot more convenient and you now have access at your fingertips to buy and sell stocks, and particularly this is for someone who has US dollars. If you are now locally, I've seen the move towards online trading. The stock exchange has moved to an online platform, and so we are moving in that direction, which is a step in the right direction. And I think it's great because that is really an opportunity to empower people. It is an opportunity to just move in that direction. So the market is a lot more sophisticated, as I'm saying, to get in line or get into where things are at on a global scale. So again, the difference is really just convenience. If you open a local brokerage account, you probably would have to pick up the phone, you probably would have to send an email, and you give your broker instructions. Can you buy X shares? For me, would you, or the instruction is buy X shares at this price. But if you were doing this online on your phone, the same conversation you would have, you would now click buy, you would click sell, you would type in the security, whether it says you made a mention of Apple, you type in the ticker, which is a code for the, that's a symbol for the stock, you type in how much shares you want, type it in and all on your phone, and you click buy. That's it. That's how you would do it on your phone once you get the account open. Different, obviously, as I said, if you were doing it locally, but I've seen the move towards online investing in Trinidad and Tobago, which is a great step.
Right. So basically, if you have that access to the U.S. currency, online is definitely the better option for you as well as gathering.
Online will be the only way, because to have.
Well, yes. Yeah.
Well, let me be clear. Online would be the only way to directly access, like say you said you wanted to buy Facebook or Apple or directly, you would need an online brokerage account. The indirect way is if you invested in a mutual fund that has it within the basket of stocks. They do have Apple and Facebook and Amazon and Google and all of these stocks pooled together. You have access to it. And probably even by using TT dollars, because there are mutual funds that you are investing in TT dollars, but the fund is also invested in US assets, which again is a hedge or protection against inflation. So once you're investing and you're thinking long term, you're protecting yourself, you're protecting the purchasing power of your dollar, which kind of gets back to saving, which you have less protection there because you're earning less. There's less risk, but there's also risk. So and I want you to know there's risk in not taking risk, particularly for a young person. So I know some people that are ultra conservative, and I don't want to lose anything. I don't want to lose anything on my principal. I just want to put my money, park it up, and that's fine. I think that's a good place, at least if you know that about yourself. The other thing that you would need to understand with that is that there's huge risk in not taking risk, particularly when you're a young person, because you cheat yourself or you rob yourself. You don't give yourself that opportunity to have the long-term growth and have access via the stock market or via a growth type mutual fund where you can position yourself for growth to achieve goals.
I think that's a great point that has answered Radhika's question around people who may not be risk tolerant. I think, millennials, we are a bit younger, so we have a little bit more leeway. I want to ask Melanie's question, her very first question, because she was here very early. And I want to ask her question around her daughter's university fees, because I'm sure a lot of parents can relate. So she's asking, I need to pay for my daughter's university fees, but do not want to touch my various nest eggs. How do I balance both?
That's a good question. I mean, so not touching your nest egg, but the thing about it is if you have the fees to pay, you have the fees to pay. So I think it may, in a situation like that, is reevaluating exactly what you have in your nest egg. Certainly, if the question is hinged on, should I take some of the money that I have to pay fees to put it into an investment, I would not advise. It will depend on when I say it has to be something that is short term, that is protected, because fees come up every year. Fees are not something that you pay, you have a lot of time to pay. So that money is really money that you want to have somewhere that it's safe. So there are mutual funds that invest in fixed income, so a bond type or fixed income type mutual fund or money market fund. It's not going to give you the best return, but it certainly is going to give you a better return than what the commercial banks give or a traditional savings account is going to give. And why that is because, again, think of the whole concept of pooling assets together, and now income fund, a fixed income or bond or income type fund invested in bonds, and the income from that is now passed on to the investor. So this is something that is a lot safer, that doesn't have the opportunity to generate any income at all. The other option for a fixed income type instrument, but that's ultra safe. Returns are very low. It's a money market fund. The money market fund is, so I spoke about a bond, and a bond is long term, anything past a year, lending somebody money, a gigantic loan. Money market fund has instruments that mature in less than a year. So that is, say, one financial institution going to the other and say, listen, I want $1 million and I need it for 365 days, or I need it for 270 days. This is the arrangement that we're going to come to, and I'm going to pay you this interest for allowing me to have this $1 million for these 30, 90, 60, however much days. And a money market fund, that income is passed on to the investor. But I know the question will be, well, what are you going to get on a money market fund, and what do you get on an income fund? You will earn more, but rates all around the world are at the lowest probably they've ever been for a decade. So I'll just give you an example. So that's why it's important to know how you are positioning your money. Because traditionally, or I would say 10 years ago, let's say 15 years ago, if you parked your money in an income fund or even a money market fund, you would be earning a lot more than you are earning today. So that is something to think about, because interest rates are, as I use the example of the United States, the benchmark rate is 0 to 0.25%. And US, this rate kind of sets the tone for rates around the world. The rate that in Trinidad and Tobago that sets the rates for the banks is known as the repo rate. It's at 3.5%, and it's been there for some time. So rates are very low. Fixed income type securities, particularly money market funds, are paying low rates because of what's happening around the world. So central banks have lowered rates so that the economy can be stimulated, so that people possibly hopefully take more loans, because it's much cheaper when rates are lower to borrow. And that is one of the tools that central banks around the world use to set rates and to stimulate the economy. So not to diverge and get too complicated, rates are very, very low. So you have to be mindful of that when you're putting your money in a money market fund or an income fund. Also have to be mindful of the fact that if it is you need these funds within a year, you don't want to be putting that money at risk in stocks or in a fund that is going to fluctuate, and then now the principal could be a little lower than you anticipated at the end of the year, and you don't have the time to wait for it to recoup the losses. I hope that answers it.
Well, our comment section is proof that our audience is way smarter than I could ever aspire to be, because some of these questions I'm like, what? But I'm going to ask them. Rahika seems to be a bit risk adverse, because she wants to know, how often should a mutual fund investor review their portfolio to determine if changes are necessary?
Very good question. Very good question. So, I mean, somebody might be ultra meticulous and you might look at the price. So your mutual fund is mandated to put out the price every day. Most mutual funds, price will be in the papers, or it's going to be on the website somewhere. You could check that every day. Chances are it's not going to have any drastic change, but certainly, for the very least, on a quarterly basis, you want to look and see how the fund has performed over a quarter. If you don't have the quarterly information, definitely semi-annually, and it should never be, well, you definitely want to know what happens at the end of the year. But I will say a good gauge, a good benchmark is a quarterly review to see, well, okay, the mutual fund is performing this way, and ask the reason why. So not because the mutual fund is not performing the way you expect it to perform. You might want to get the background information as to why the fund is performing that way. But things are not that great in the economy. Stock market is down. So, you may want to either A, hold strain, or B, say, I'm going to take on more risk. It just depends. But certainly quarterly is a good time. Quarterly review is a good benchmark to monitor your investments and see if any changes need to be made and if you are on track to achieving the goals that you would like to achieve. But it doesn't mean that because you're not quite there, or it doesn't perform the way you want it to perform, that doesn't mean that you jump out. Definitely means that you start asking the questions that you need to ask, more forward-looking questions to the investment advisor regarding what should I expect 6 months out? What should I expect in 2022? What should I expect in terms of the performance of this fund? And this is really important. I think a lot of times people park up their money and they say, well, okay, I just put this here and because a lot of times I ask people, so what do you have? And they say, well, I have this mutual fund. have this mutual fund and I don't, I say, so which fund is it? Is it a long-term fund? Is it a short-term fund? But I really don't know. And I said, well, okay, that's something that you need to know because that's how you're going to know if you're well positioned. So staying on top of your money, minding your business, because you are like a business, minding your business, very ultra important, and quarterly is a good time to do that.
Okay, so we have the last question because we have to wrap up in a bit. Casey wants to know which is the best savings vehicle to save your emergency fund.
Good question. I would say an income fund, Casey, and I'll tell you why. Why? Because you're going to get a higher rate than you put into like a commercial bank account. You're going to have access to bonds on the international market. You're going to have access to bonds on the local market, corporate bonds, government bonds. And I said, I'm not trying to confuse gigantic loans that corporations take and governments take to handle the business, and they pay the investor. So an income fund is a good place but make sure that income fund you have access to ease of access and it's liquid. So if you want to get your money next week, tomorrow, or whenever, you have access to it with no penalties. The other option would be a money market fund. Reason I would go with the income fund over the money market fund, as I said, is because a money market fund rates are very, very, very low. Yes, your principal is more or less guaranteed. There's zero risk, or very, very little risk there. But you can take on a bit more risk with the income fund, have access to your capital if you need it for an emergency, and be fairly compensated for parking of this money and leaving it there, which could potentially be for some time because emergencies don't happen every day. So I will recommend an income fund first, or a money market fund, but definitely not a long-term fund like a equity fund or balance fund that has a lot of stocks in it, or investing in stocks is no place to put emergency money. Please don't do that. No place. So emergency money should be safe, so that you have access to it and you get a decent return and no major charges.
Great advice. For those who are just joining us, you're definitely going to have to click on the replay because we're going to close off now with some closing thoughts from Philip. If you're just joining us, make sure to smash that follow button. And if you want to continue the conversation, if you scroll down on the bottom in the comments, you'll see Phil's connection to his Instagram account. He has really great information that is a best price. Like, you have no excuse but to follow him on Instagram and make sure that you get that information to have that fund for a rainy day, whatever that looks like, because who was expecting the life we're living right now? Anyway, so Philip, can you give us some closing thoughts for those who may not necessarily understand everything that you just said and want to be able to figure out what to do next? Can you give them some insight?
Sure, no problem. And I'm going to end the same way I started. I want you to know that you can invest. It's not far-fetched. Investing is for you. It's not for the wealthy person. It's not for the businessman. It's for you, right? Let's start there. And it just really starts with you believing in yourself, to know that you can position yourself to grow your wealth. Your financial journey is unique to you. So really stay focused on that. Don't think about what other people have on their salaries. That is very distracting, and it could be a little bit disappointing. So focus on what your goals are, and it really boils down to the mindset that you have. Are you paying yourself first before you give anybody else the luxury of having that hard-earned money that you work for? Are you paying the gym first? Who are you paying first? You really need to be paying yourself first, because you are the business. Once you have the right mindset, and that is mixed with the financial knowledge, that might seem to be complicated, but it really isn't. You combine that together, mindset plus the knowledge, you are going to be well on your route to financial success. Phil, the gap is here for you. So all of the questions that said we didn't get answered, investment advice, personal finance coaching, Phil, the gap is here for you. So even if we didn't get it done, we didn't get it covered here, please, as I said, visit the page, visit the handle, and you can always drop a DM, and I'll be happy to assist and happy to answer your questions. You can invest, you can grow your wealth.
Thank you so much, Philip. Such a great session. I learned a lot. I will also be sliding into your DMs. And thanks again for the session. And for those who don't know what this is, Straight Off the Bat live show that is aired on Thursdays on Bankers Association of Trinidad and Tobago Facebook page, as well as our YouTube channel, where we cover all things financial literacy and education. Because during these times, we really need to figure out how to do more than survive. Some of us are surviving, some of us trying to figure stuff out, and that's where we want to do these sessions for you. So the least you could do is follow that, because there's our best price, guys. This is free, you know what I mean? Anyways, see you again in our next session. Don't forget to sanitize and mask up, and we are all hopeful that we will come out on this the other side. So see you soon, everybody. Bye.